What's going on, guys? M1Finance here. Welcome back to the channel. Today we're going to discuss QYLD or QYLD, everyone's favorite income ETF, or at least YouTube's when it comes to views. The reason for this video, I personally have around 500 shares, a little bit less, of QYLD myself, and I've been talking to my tax accountant about tax situations that I'm going to face, going into the new year. I have quite a bit of crypto trades, and then I also have these income ETFs that I didn't have a full understanding on how I'm going to be taxed. So I did my own research and I found a lot of information. And I think with this video, you guys are going to find some benefit from all the research that I've done. Now, one thing to remember is I am not a financial advisor and I'm not a certified tax accountant. So make sure you do your own research. This video is for entertainment purposes only. So in this video, we're going to discuss the different types of distributions you can receive from companies or ETFs such as QYLD. Now, the three different types of distributions are going to be ordinary dividends, qualified dividends, and return of capital. We're going to define each one. We're going to talk about why they're significant. And then after that, we're going to talk about QYLD specifically and where to find the tax information when it comes to QYLD's monthly distributions. At the end, we're going to talk about how to potentially avoid these taxes, maybe taking advantage of some tax advantage accounts, and then my personal thoughts on doing that. So let's get right into the video. So the first thing we're going to talk about are going to be ordinary dividends. Now, ordinary dividends and short-term capital gains are taxed the same, and the way that they're taxed is basically just like ordinary income. Now, what that means is when you work a 9 to 5 and your company gives you a W-2 form, you're being taxed based on your income. Now, you have different levels of taxation based on how much money you make. So for instance, if we look at the spreadsheet right here, if we are a single individual and we make, let's just say, $88,000. Now that's between $86,000 and $164,000. In 2021, if we normally made $88,000 from our job, they gave us a W-2, but then in addition to that, we received dividends that are considered ordinary dividends, not qualified. We made $3,000 there. So our total income went from $88,000 to $91,000. We would pay an additional 24% tax on that income. Well, if we use that $3,000, but instead they were long-term capital gains or qualified dividends, as you can see here, if you were single, the first $41,000 wouldn't even be taxed. Then you'd have a 15% rate and a 20% rate. So even if you're making almost 500 grand a year, you're still being taxed less than the 24% of ordinary income or ordinary dividends. So whenever you can take advantage of qualified dividends over ordinary dividends, you want to be able to do that. However, with QYLD, it's not so easy because QYLD has a mix of long-term capital gains and short-term capital gains. And in addition to that, they have the return of capital, which we're going to discuss next. So we just discussed the different types of taxation between the ordinary dividends and qualified dividends. Now, what qualifies a dividend to become qualified? Well, a qualified dividend needs to be either a US-based company or a qualified foreign-based company, and there needs to be a certain holding period that's met. Now, the holding period can get pretty confusing, so if you want to look at that, you can go down the description, you'll see an Investopedia link, look at that, and it'll give you the exact description. However, in addition to that, it also can't be considered non-qualified by the IRS. Now, things that wouldn't be qualified would be like REITs or real estate investment trusts, master limited partnerships and stuff like that. You can get more information in the description below. But the third type of dividend or distribution is now going to be return of capital. Now, return of capital is when there isn't any actual income or gains paid out. What it is they take the investor's capital and give it back to the investor in the form of a distribution. And with that, it creates some interesting tax implications. So with return of capital, you basically have what's called a deferred tax, because when the distribution comes to you, as long as you don't sell the actual asset, you're not going to pay taxes on it. What will happen is your cost basis will be adjusted by the amount of the return of capital. We're going to do an example of this later on in the video. So now that we're on the actual QYLD website, we're going to look at how the company Global X deals with their taxes. So when we go down here, we can go to the Covered Call ETF Tax Primer, and we can see a specific example talking about QYLD. Now, this is for 2019, and we're going to look at 2021, which is even different. However, they talk about in 2019, the total distributions was $2.32 per share. Of those distributions, $1.97 or 85% was treated as ordinary dividends or short-term capital gains. Another 3% was treated as long-term capital gains. Lastly, 12% was treated as return of capital. Now, this was back in 2019, and a lot has changed since then, and obviously that's because the markets have changed. So if we want to see specifically how we've done this year, we can go to the next part, which is supplemental tax information. And on here, you can scroll down, you can find whatever fund you want to look at, which we want to look at QYLD. So we're going to go ahead and click on QYLD, And let's just go ahead and look at the most recent one. So when we open this up, we can see that we're going to see the total distribution for the month of October. We're going to see the current distribution, whatever that was, and then it's going to give us the breakdown. So when we look at this, we actually see that year to date, 99% of all of the distributions in 2021 have been return of capital. Only 1% has been investment income. And one thing to realize is that this does not give us our exact tax information. This is only an estimate. It does not really break down what's going to happen at the end of the year. What will happen is you're going to get a Form 1099 div, and that's going to give you the breakdown of all of your short-term capital gains, long-term capital gains, and return of capital. And remember, with return of capital, you're not going to pay taxes on that portion of the distributions. So far, moving through 2021, it's looking like we're not going to have to pay a lot of taxes. So for me, making around $125 a month, this is good. I don't have any plans of selling my asset anytime soon, so I'm perfectly fine with this. So real quick, before we talk about if QYLD using almost 100% return of capital is a good or bad thing, I want to give an example of the actual return of capital. So in this, we're going to talk about the initial share price being $23. Now right now it's a little bit below this, but for the example, we're going to say that this is what it is. We're going to also say that the dividend that was just paid out was 22 cents. Now, when we look at this, we had an initial cost where we bought in, we're just going to buy one share of $23. Well, we were paid 22 cents and it was 100% return of capital. Our new cost basis, even though we paid $23, is actually $22.78 because we took some of our capital in the form of a distribution. Our new price, 1 year later, we're going to say is $25. Now for the example, we're going to pretend that no other dividends were paid. Obviously this isn't the case, but this just helps with basic math. If we were to not have return of capital and we decided to sell our one share, our share went from $23 to $25. It appreciated by $2. We now owe capital gains on $2. However, with return of capital, we now owe capital gains taxes on $2.22 if we go to sell the initial share. This may not seem like a lot, but if you're holding long term and you've decided to allow your cost basis to go all the way down to $0, well, what happens then? Well, if you sell the asset, you're going to owe taxes on the entire value of the share, and any additional distributions before you sell are going to be taxed as either long-term or short-term gains. So you will no longer have that benefit of the deferred tax. So what if you don't want to deal with any headaches in terms of taxes? You just want to put your money in and you don't want to have to worry about any taxes in the future. Well, luckily we have tax advantage accounts. As long as you are eligible for it, you can contribute up to $6,000 if you're under the age of 50. And if you're over the age of 50, you can do an additional $1,000. So what would happen if you put the $7,000 into QYLD? Well, you could. However, I personally think that's a poor choice. And the reason for that is if you're a younger person and you plan on investing in a Roth for 20 or 30 years, why would you limit yourself to the advertised 12% dividend yield? Or if we look at the history, we have growth of 8% from 2014 to 2021. And remember, past results don't guarantee future results. However, if you had just invested in something like a growth stock or a growth ETF using the same index over the NASDAQ QQQ, we have a growth of 21%. So you can see over time, you have a significant increase in your total portfolio value. I like QYLD for the monthly income, but I don't see it as a way to grow my portfolio long term. I see it as a way to inflate my lifestyle in the future or to retire early if that's what I plan on doing. So in summary, when it comes to income ETFs such as QYLD, we can't actually say exactly how they're going to be taxed because it changes every month. What we've seen recently is that QYLD generally pays out almost 100% return of capital. Is return of capital a good thing? It can be good or bad depending on what you're trying to do. Just remember, it doesn't mean that you're not going to pay taxes. It just means that your taxes are deferred until you sell the actual assets. If you found anything useful in this video, please hit the like button. Make sure you subscribe to the channel. I hope to see you guys next week. If you have any questions about the video, leave them down in the comments, and I'll see you guys next week.